Welcome back. This is Financial Accounting, and today we are going to learn about accounting for long-term debt and things like bonds or notes payable. So when it comes to accounting for liabilities, accounting differs quite a bit between current and non-current liabilities. Current liabilities are accounted for on the balance sheet at their settlement values, basically the amounts that we need to pay to get rid of those liabilities. Okay, there's no discounting. The accounting is very straightforward, and that's why we are not talking much about current liabilities. When it comes to non-current liabilities, accounting is going to be quite a bit more involved because we need to discount future cash flows and we need to adjust values of the liabilities over time following so-called effective interest rate method. Okay, so we'll find out how this works. For now, examples of non-current liabilities include bonds, notes, bank loans, mortgages, leases of certain types, like capital leases. Right, so we're going to take all these future cash flows and discount them at the interest rate that was in effect on the day when this liability was acquired. Right, when bonds were sold, we record the liability. At that time, we determine interest rate, that is the effective interest rate on that day, and we use that rate throughout the life of a liability. Right? This is the reason for why present value of future cash flows may deviate from the fair value of future cash flows. Okay, so those two need not be the same. Okay, and this is also why we say that we account for liabilities at historical adjusted cost. Right? We basically use historical interest rate, and therefore accounting follows historical cost. Okay, so let's talk about accounting for bonds, and once we understand the bonds, we are going to understand all types of long-term debt. Okay, let's talk about some terminology first, right? A bond is a financial instrument that basically involves promising to investors to make periodic payments, so-called coupon payments, at pre-specified dates, as well as one lump sum big payment at the end of bond's life, right? So we are going to promise to make these payments in exchange for receiving some amount of money from investors upfront. That's going to be the price at which bonds are sold. Okay, so par value is the amount paid at maturity. It's also called stated value or face value or principal amount. So there's a bit of different terminology. Coupon rate or stated rate is the quantity that is stated in bond contract. Right, it used to be stated on the face of the bond. This is the amount that determines coupon payment. Right, coupon payment is basically par value times the stated rate. Okay, or times the coupon rate. But we also have effective interest rate, not just stated rate. So effective rate is different from the stated rate. Effective rate is the rate at which market prices the bonds. Okay, this is basically also called yield to maturity or market interest rate. Market interest rate determines what is the rate of return that investors are going to earn per period of time, as opposed to the stated rate. Stated rate tells us how much they're going to receive every period, right? But receiving cash and earning cash are two different things, and we are on an accrual basis. So we're going to have to take into account the difference. Okay, so this is how the bond is valued, or a bond. Right? Basically, price of a bond at time zero is going to be present value of coupon payments over here, right? And this is something that we call a value of annuity, right? Annuity is a set of payments of the same magnitude for a number of periods. And then we also have, of course, today's value of the lump sum payment that comes in the end. Okay, so bond value is determined this way. And basically, we have a coupon payment, which is equal to par value times stated interest rate. But then in the denominator, we have so-called market rate that is used for discounting. Okay, market rate is the rate of return that investors are going to earn. Okay, and this is the amount, the interest basically that company is going to incur each period. Okay, the market rate of return is equal, and this is something that you can basically verify by taking this formula at time t plus 1, and basically subtracting one from the other to verify this equation. So market rate is going to be equal to cash that basically investors receive plus change in the bond value divided by the beginning period value of the bond, right? So this is rate of return that investors earn. It consists of cash that they earn, but it also consists of appreciation or maybe depreciation in value of the bond, okay? So that's basically the effective or market rate of return, as opposed to stated rate of return, which determines how much payment investors receive per period, okay? Something important to note is that the same value of the bond can be achieved through different combinations of coupon payments and par value, right? Some firms prefer to minimize coupon payments to wait until some of their investments will start paying off, right? In this case, they can reduce the level of coupon payment, right? Reduce the stated interest rate, but at the same time increase the par value that they're going to pay in the end. And they will be able to find a combination such that they can raise the same amount of money they wanted initially. Some other firms prefer to pay larger coupon payments so that they don't have to pay large lump sum amount of money in the end, right? For instance, that's how mortgage works. You don't pay a large amount of money in the end. You pay larger fixed payments that recover the amount that you borrowed essentially over time. Okay, so we need to next understand concepts of bond premium and bond discount. So we are going to take this very simple bond that involves maturity in 2 years, and it involves basically 5 payments in the end of each 6 months, $5,000 each, and 100,000 par in the end of the bond's value, right? So that's the value of the bond that we've just seen. So we are going to consider these 3 scenarios. Basically, this bond can be sold at par. It could be sold at a price that is lower than the par, right? In which case that we have discount, or we can sell this bond at price that exceeds par value, in which case we would have a premium, okay? So here are some examples or some sort of mechanical calculations that happen when we have a bond issued at par, right? So at par is the case when stated and effective interest rate are the same, okay? So there are 2 quantities that we need to kind of understand. Quantities that come from the contract and quantities that come from the market, right? And so this contract says that we have 100,000 10% note, so that's stated, right? Those are stated amounts. 2 years with semi-annual interest paid in arrears, meaning in the end of every 6 months period. Now, pricing, which is market quantities, note is priced at 10% annually or equivalently at 100% of par. Okay, so basically that means that investors give us exactly the price equal to the par value. Okay, and let's see how valuation works more specifically, right? So we have here annual quantities, which is 10%, and then we need to calculate semi-annual quantities because cash payments happen semi-annually, and of course for this reason we need to adjust the discount rate to be also semi-annual. Okay, and so of course semi-annual quantities are going to be 5%, and we have 4 periods. So the cash flows are going to look as follows, right? We have basically, this cash flows that we are going to discount, right? And so when we discount each of these cash flows, we get the following quantities, right? And then we sum up all these quantities, and we're getting exactly 100,000, right? So 100,000 what we're getting up front when investors price these bonds at 10% annually is equal exactly to the par value that we are going to pay back on the last day of this bond issuance, of this bond's life, right? So there's no premium or discount. The bond is sold at par, and of course that's the case when market and stated interest are the same. Now let's take a look at the case when stated interest is lower than the effective interest rate or market rate. Okay, this is the case when we have a discount. Okay, so the contract is going to be exactly the same, whereas now these bonds are going to be priced at 12% instead of 10%, right? So, market somehow views the company as a little bit more risky and therefore increases the discount rate. Okay, so in this case, our semi-annual quantities are going to be 5% and 6% for coupon and market rate respectively. And the cash flows are going to be identical, but of course the present values of these cash flows now are going to go down. They are going to basically go down relative to the case what we had previously because discount rate went up. And so each of these quantities is going to be a little bit lower. And then when we add up all these present values, we are going to get 96.5 thousand. Okay, so this bond is going to be sold for 96.5 thousand to investors who use 12% for pricing, right? Investors will be willing to give us basically the present value adjusted for their required rate of return. And we say that this bond is basically sold at 96.5% of par, right? The difference between the amount that we receive upfront and the par value paid at maturity is equal to the difference, negative 3,500, which is the discount on this bond. Okay, and then when we have a case of premium, when stated rate exceeds the effective interest rate, basically the following happens. We have, again, the same contract, but market rate now goes down to 8% instead of being 12%. And in this case, semi-annual quantities are 4% and 5% for coupon and effective rates, respectively. And so while cash flows are the same, while cash flows are the same, pricing is going to differ because now we have lower discount rate. So all quantities are going to move up a little bit. And so the present values that we have over here are going to be higher, and they will add up to 103.6 thousand. Okay, so because 103.6 thousand is greater than the par value, we say that the bond is issued at a premium, at 3% premium basically of par, and that's basically how our calculations are going to look. Again, investors are going to be willing to pay us 103, but we are going to pay back 100 later on. Okay, why do we have premium or discount? Premium or discount doesn't mean that we get great deal or bad deal. Everyone is pricing bonds rationally. A premium basically means that market is charging the company 8% per period for capital that they provide, whereas company commits to pay 10% in the contract, right? So if company commits to 10%, but market charges only 8%, market is going to price this bond at a premium relative to the par value, right? Because we're paying 10% of premium, 10% relative to the par value. Market is charging only 8%, so market will reward us and give us more money as compared to the par. Okay. In case of a discount, if we go back over here, the opposite is true, right? The intuition behind discount is the following. Market is pricing the bond at 12%, but for whatever reason, suppose we are cash constrained, we are willing to pay only 10% per period, right? So we are only paying 10% of par value, but market is charging us 12%. So therefore, it's got to be the case that market is going to price this bond at less than par value in order to determine its fair price. Okay, so this gives you a good idea of what premium and discount on bonds are and how they arise, and what's the underlying mechanics behind these calculations, right? In the next video, we will talk about how these bonds are accounted for and what happens over the life of a bond. Okay.